15% erosion in profit margins. That's the silent threat businesses are battling globally. Unstable exchange rates and rising interest costs are squeezing companies right now, making even giants like Nike feel the heat. Here's what's actually happening. Interest rates are under constant pressure to climb, and currency exchange rates are swinging wildly. These aren't just abstract numbers on a financial report. They're the direct forces challenging regulatory bodies to keep economic growth stable and support businesses. When a company operates internationally, these shifts directly impact their bottom line, from sourcing materials to selling products across borders. That relentless plunge isn't just bad luck. It's a symptom of a deeper, systemic financial stressor. Every global business, whether it's a tech startup or a multinational apparel giant, is wrestling with these unpredictable variables. It's creating a volatile environment where stability is the biggest challenge. What's wild about this is how quickly these macro shifts ripple through the market. Experts are now warning that regulatory bodies face a monumental task: maintaining stability while supporting businesses and boosting economic growth. Imagine being an Amazon FBA seller importing goods. A sudden swing in exchange rates can wipe out your entire profit margin overnight. Or consider a SaaS startup trying to scale globally. Rising interest rates make securing capital more expensive, directly impacting their runway. This isn't just about big corporations. It's about every entrepreneur trying to build something meaningful. And the increased cost of doing business is a cold, hard fact. The pressure is real, and it's forcing a reevaluation of every growth strategy. Here's what nobody mentions. While some are panicking, smart entrepreneurs are already adapting and even profiting. The instability that's squeezing traditional businesses creates massive opportunities for those who understand how to navigate it. Think about it. When global trade gets risky, localized solutions or services that help businesses mitigate exchange rate exposure become gold mines. We're seeing savvy freelancers offering currency hedging advice, or Shopify stores pivoting to local-first sourcing models. The real winners are building agile businesses that aren't dependent on stable global markets. They're leveraging tools for efficient capital management or creating niche services that thrive on volatility, like specialized financial newsletters breaking down these very trends for busy founders. The so what for you is simple. This isn't a time to retreat, but to reevaluate where the market needs solutions. Your actionable step today. Explore how you can offer a service or product that helps businesses reduce their exposure to rising interest rates or volatile exchange rates. That's where the money is, right now. Hit subscribe if you're ready to turn market fear into financial advantage. Top analysts from Bloomberg Economics are ringing alarm bells, projecting a prolonged period where rising interest rates remain a major drag. They're not just whispering. They're explicitly stating that the pressure on currency exchange rates isn't a temporary blip. These experts are urging businesses to brace for a new normal, where borrowing costs are persistently higher, making expansion incredibly difficult for those reliant on cheap capital. It's a stark warning about the foundational costs of doing business, impacting everything from supply chains to consumer spending power. Across the globe, developing economies are feeling the sharpest bite of this currency upheaval. Countries heavily dependent on imports or foreign debt are seeing their national currencies devalue at an alarming pace. This isn't just theory. It means their purchasing power shrinks, making essential goods more expensive and fueling domestic inflation. Wealth managers are advising clients to diversify assets away from these vulnerable regions, highlighting how quickly local economic struggles can translate into lost value for global investors. Cast your mind back to the late 1990s Asian financial crisis. That period saw immense currency devaluation and soaring interest rates, crushing businesses unprepared for the sudden shift in capital costs. Today's situation, while distinct, echoes that fundamental pressure. Strong currencies weakening rapidly, central banks scrambling to intervene, and a domino effect on regional economies. Those who survived then did so by adapting fast, cutting debt, and finding local market efficiencies, a painful lesson many forgot. Surprisingly, A specific niche of SaaS providers is actually thriving right now. Companies offering tools for precise inventory management and localized pricing strategies are seeing surging demand. Their clients? E-commerce stores, leveraging platforms like Shopify and Amazon FBA, desperate to optimize margins against currency fluctuations. On the flip side, brick-and-mortar retailers with long supply chains and high overheads are bleeding cash, unable to pivot quickly enough to absorb the increased costs of goods and borrowing.